Okay, hold on.
What's wrong?
Okay, you're right.
I'm live?
Yes.
Okay. Hi, it's Larry McDonald here. We wanted to bring you to this new show called The Lens with Craig Shapiro and Larry McDonald. I think it's one of the most unique platforms in the world because Craig and I and our team, we have a team of about 8 people. We run a conversation on Bloomberg with hedge funds, mutual funds, and pension funds. And what we want to do is once, a couple times a week, and then with our new report called the One Idea, we're going to kind of condense the most important things that we're seeing through the day, through the week, out to a broader audience, right? Because Craig and I have been on essentially on the buy side for a long time with institutional investors, really trying to democratize information. Craig, today, you've been running the conversation. You've been talking to the largest CIOs in the country. What stands out? Like, what are people talking about, and why is that important for the people watching us right now? Why is that important for retail, family offices, wealth managers?
Yeah, thanks, Larry. I mean, a couple things, clearly geopolitical concerns are top of mind after yesterday with the attacks, Iran and Israel. So folks are very focused on whether or not there'll be retaliation, what that retaliation might look like. I know yesterday we talked about whether or not Israel might attack oil infrastructure in Iran, the Karg island where Iran has a tremendous amount of its oil facilities and its refining. To the extent that Israel attacks something like that, could have major implications for the oil universe. Iran has said that if that happened, they would attack Saudi or UAE. So clearly, an escalation. People are very focused on what the
Yeah,
next.
I mean, it's, we had the April attack on Iran on Israel in this one, and it's clear it's a more advanced attack that gave the US less notice. So this is definitely it's an escalation, but as one of the portfolio managers told me in the chat, it's an escalation, but it's not a giant escalation, right? So, but then you have the anniversary of tonight at 5 o'clock at sundown, the holiday kicks off, right? And then when you have the anniversary of last year's tragedy, right? So, and then you have the Yom Kippur. How does that relate to it all?
Yeah, I mean, there will be
Like,
further
in other words,
escalation. I think people are waiting on bated breath here, right? I mean, you have Rosh Hashanah starts tonight. Then there's historically, the army would not be doing much, but if you go back to 1973 and the Yom Kippur War, I mean, they were forced into action, during a high holiday. So it's unclear. They may use the element of surprise to do something tonight or tomorrow, the next day when maybe people weren't expecting it. I know the Biden administration came out today and said, they would not approve of Israel attacking nuclear assets
of course. Oh no, of
in
course.
Iran. So,
That's
I mean,
insane. Yeah, but they're not going to
but
attack it.
look, I think Israel is doing what Israel wants to do, and as far as the markets are concerned, clearly major implications for the energy markets and for the bond markets, and so yesterday with the
But in terms
uncertainty.
of the markets, what some of the PMs have been telling me, and the VIX has been making these higher lows, right?
Right.
So if say you're an investor watching us right now and you're in the market, a lot of people have these big gains. So in the work that Craig and I and Robert Van Battenberg have done over the years is in years where the S&P is up a lot. Um, People have big gains. And when you come into a weekend or a week like this, people are willing to burn a little bit of that cash on hedges. And so if you look at the VIX, it's been making these higher lows, which is, I think, interesting. And then think about it. Right now, you probably want to be hedged at least through the anniversary of last year's tragedy, right? Because the retaliation may be timed with, I mean, the next retaliation may
Yeah.
be timed. And so maybe vol could be bid through the week. I mean, that's what I'm hearing. So that means you want to look at the VIX, look at the UVXY. Is that the way to look at it?
Yeah.
Vol could be
Yeah.
bid until there's a relief, until we know that we're through the kind of the period where there may be a strike.
For sure. I mean, you have major macro news for the rest of this week, culminating with Friday's non-farm payroll report. So that's a major market activity that'll help dictate whether or not the Fed is going to be more aggressive or less aggressive in its easing cycle. So folks are already thinking about having to hedge for that. But then you bring up just the weekend risk, and obviously, countless geopolitical acts have been done over long weekends, and so I would imagine that volatility will stay firm into the weekend. And so, folks will have hedges on for Monday or for next Friday. And so, yeah, I think that's gonna continue, and we're gonna, probably be dealing with this geopolitical stuff now for the next several weeks. And the other thing, just with respect to volatility and uncertainty, obviously, is the election. That's another thing folks are talking about. Not so much a debate last night. I think that's kind of not really too much of a market moving piece of news, but just the broad uncertainty about whether or not who's going to be the next president and what the administration is going to look like, and whether or not there's going to be a Republican sweep, a Democratic sweep, or some sort of split Congress. So that uncertainty is finding its way into the economic data. It's finding its way into the market, and so volatility for November is a little bit more elevated as folks are thinking about protecting large gains.
Yeah.
They've had this year.
And seasonally, October's, I think, the second best month of the year, right? For the VIX.
Yeah.
Second best month of the year. I think it's the second. I mean, historically, look, you go back 20-year average on Bloomberg. Craig and I have been using Bloomberg for years. And Craig, get into what some of the institutions have been using now, the new Bloomberg tool that you found this morning, and you've been great kind of catching these things early in the day. But there's a tool where they're using social media to try to. There was another. We're just seeing over and over and over again companies that face middle class, consumers are just over and over missing, in a lot of pain. Craig, what's the function that you're using on Bloomberg for this?
Yeah, Bloomberg's got a great tool. It's called Trend. Basically, it aggregates news activity as well as social media activity across basically any ticker, any company, and really any major topic. And so, one of the things we certainly were seeing today is some of these consumer related companies, whether it be Harley Davidson or ConAgra or Nike, all reported suspect earnings either after the close last night or this morning, where a broad array of these consumer companies are talking about pricing pressures and margin pressures as elevated inflation concerns. And
a lot of these stocks too, Craig, have made, as you can see from July, this Harley was up like $8. So a lot of times it's not the news, it's the reaction to the news. In other words, okay, the stock ran up into the earnings. So it's a little bit of like, okay, the earnings might not have been that bad, but the stock was up large into them. So in a bull market, companies will run into the earnings and then keep running, right? And kind of in a market where you want to be a little bit more careful, I'm not saying we're in a bear market, but like, okay, a lot of companies are running the earnings and then selling off. It's not the news, it's the reaction to the news that you have to listen to, how to listen when markets speak. Let me give a quick shout out here. Top seller on Amazon, this great Christmas present. And so we're going to go just back because we're going to go to the VIX here for 1 second. I just wanted to show, the higher lows. Can you break up the next chart? Jose? Craig, go back to I think Harley and the connection, with what the institutional investors are saying in the chat.
Yeah, I mean, basically, the company reported, weak sales, excess inventories, cautious sentiment. I mean, we're hearing more about cautious sentiment and uncertainty. We're seeing, the guts of the ISM index, which is the survey manufacturing, came out earlier this week, or the services PMIs, which are sentiment indicators. A lot of talk about uncertainty and the uncertainty around the election. And that's leading to a slowdown in hiring. It's leading to a slowdown in corporate CapEx. It's leading to a slowdown in consumer outlays for durable goods, certainly autos. Plenty of companies have come out over the course of the last couple of weeks. Volkswagen, Mercedes, Stellantis, which runs Jeep, talking about a slowing consumer for big ticket items. And a lot of that has to do with the uncertainty around the election and tax policy and the labor market momentum into 2025. So, that's going to be with us for the next 5-6 weeks. Hopefully we'll have a result on November 5th. I suspect we will, but there's plenty of uncertainty about what the regime will look like for 2025.
Yep.
As it pertains to taxes and as it pertains to the budget deficits.
So we've been in this China trade since near the lows of 2022. It's been absolute torture. one of the things that we do is we measure capitulation. We have a multi-factor, 7-factor capitulation model, and we want to buy into capitulation, lighten up into the rally, and be there for the turn. But as we saw with Cameco when we were in that trade in 2020, 21, same thing with Exxon, you have a really horrific, a lot of fake rallies that it looks like you're going to come out of the bear's grip and you kind of get stuck back in. And that's what's happened with China for a long time. And it's really creates what we call seller exhaustion, where everybody just completely gives up on the trade. And what happens is, because everybody gives up on the trade, the ownership base owns the China equities at such a low price. In other words, everybody sold at higher prices. Nobody really owns China at higher prices anymore. So it's less and less selling pressure. And so one of the things that I talked to a famous investor today in the chat, billionaire, and he's like, listen, Tepper trusts the China move. Right now, I don't. And I really respect this investor. I respect David Tepper too. David Tepper's in our book, When Markets Speak. But I definitely caught some skeptics today around, okay, it's a nice first move, but there's a ton of problems in China. There's a ton of deleveraging, and it's kind of mixed messages. But Craig, this move on the I think it was the 14-day RSI, and then this VIX chart. This is something we've never seen before. Oh, Craig, you're on mute. You're on mute. But
I'm sorry. Domestic China market is closed this week for holiday, but there's clearly exposure that you could get through Hong Kong securities. And we've been seeing a lot of call buying and short squeeze and folks who are chasing this rally. And yeah, so it's rare that you'd see an environment where the VIX up, volatility up, and stocks up. But that's clearly what we've been getting. To your point, investors are chronically underweight China in emerging market portfolios. There's been big long India, short China trades that people have. There's been broad long Japan short China trades. There's been long US short China trades. And with the stimulus announcements from China last week and into the early part of this week, sentiment is shifting rapidly. Overall, it's probably not going to be big enough to move the entire.
So explain what's happened. A lot of real money accounts that are in the emerging market space that we call real money. So pension funds, mutual funds, they're all underweight, right? So nobody has any exposure to China. We've been lectured and lectured and lectured again. It's uninvestable, so nobody owns it. So you have like India is a country with a GDP of about 3 trillion. China's 6 times that, but India is the same percentage in a lot of these EM indices globally, right? So in other words, that just shows you have an economy in China that's 4 or 5 times bigger than India's, and nobody really owns. Everybody's underinvested. So then all at once, with David Tepper kicking it off, you just had all at once everybody's trying to catch up.
Yeah, the other thing you have is you have a new quarter, right? So you basically have investment committee meetings that take place at the beginning of the quarter, and then folks start making asset allocation decisions.
And you were at Osprey, you were at 0.72, Craig. I mean, you've been there.
I've been in the room on the buy side for north of 20 years, where these types of decisions get made. And month end and quarter end are typically time for the investment committee meeting. Everyone gets around the table, talk about best ideas, exposures for the next 3 months or for the next year. And so as you transition from September to October, from the third to the fourth quarter, people need to have these conversations about their outlook for China. It's too big an important part of the economy and potential for market cap that it cannot be avoided. And so if you've been underweight or you've been short, God forbid, you have to move rapidly in order to balance exposures, because it does seem like China and the government is making a big effort here to stabilize asset prices, to move asset prices higher, and to try to end the deflationary spiral that is taking place. It may not work, but it's harder now to bet against China than it was before.
So thanks, Craig. And so back to the VIX, it's kind of unusual in a bull market to have that many 3 months of higher lows in the VIX. I mean, that gets into how seasonality works. People are on a lot of gains. They're willing in September, October to protect those gains. And then when you have any kind of geopolitical or economic risk that's encroaching, that's where, I mean, that's impressive to have that kind of move in the VIX for 3 months with higher lows, and that's what we're getting at earlier. Craig, your comment on vol and next chart, Jose?
Yeah, I would just say, whether it was the Japan issue from August, whether it's been some of the uncertainty around Fed policy, and then certainly with the election coming up next month, there's been reason for people to think about protection, right? And certainly, with gains as high as they've been and exposures, reasonably elevated, paying up for some protection here makes a bit of sense. And so I think the VIX is reflecting that to a large degree.
Yeah, and then a lot of the crowded trades, Walmart. One thing we've seen at quarter ends, and this is so important, what we saw in, say, the end of the second quarter, so the June 30th, right? Everybody was in Mag 7, right? Mag 7, it was the most crowded trade. And then what happens is you go into the new quarter, and there was this massive rotation out of the Mag 7 and into staples, into utilities. And one of the clients has been pointing out here on Walmart, this is something you won't see really 1 or 2 times in your life around Walmart. To have it this far, I don't think it's ever been this far above the 200-week moving average ever. And the weekly RSI, so it's a little different from the daily. The weekly is a much harder scale because you get that relative strength to hold it up there for a week. As you can see, this chart goes back to 2003. And this is the longest extension of a weekly RSI that we've ever seen. And so it's fascinating that people, Craig, why do people want to own? So what's happened since the 30th of October, right? I'm sorry, 30th of June. We've had all this money, maybe $500 billion, leave the Mag 7 and go into staples, which is Walmart, like the companies that are going to do well in recessions, and utilities. Now, I know rates have come down and everybody's looking for rate cuts, but this is one really, like if you're long Walmart here, if you have it in any check through your family portfolios. To me, this is a category 5. It's like if you think about capitulation, this is the reverse of capitulation selling. This is a category 5. I got to get in, overbought. I mean, this is to me a screaming sell. Like, pound the table, highest conviction.
This is a crash up, right? It's fairly
and we've seen this with like the utilities. We don't have the chart here, but the utilities have never. It's a great way to say it's a crash up. The utilities have never been. They're almost 21% above their 200-day moving average. The utilities, right. They've never been here. Within the last week or two, same thing with Philip Morris, right? Which is another defensive. People own defensive equities like Walmart and Philip Morris if they expect a recession. But I think it's interesting that there's a number of these, like utilities, have never been here, Craig. They've never been this far above their 200-day moving average. Yeah. This is the 200-week here. I don't want to confuse people. But what does that mean? Like, Craig, like we're in the Wall Street's pounding the table on this soft landing, this strong economy, then why are people crowding into defensive equities like we've never seen before? Like we've never seen. And why are people crowding into utilities like we've never seen?
Yeah, no, to your point, I mean, there's been this rotation out of big cap tech into other areas of the market as the rally is, sort of broadened out a bit. But I think it's been this move in the bond market and a combination of just the Fed kickstarting the rate cuts, but also some of the deflationary stuff that's been going out of China, which has led to the bond market being bid in China, some of the European growth concerns, Japanese growth concerns. So there's been a little bit more of a concern about global growth momentum, which has allowed bonds to rally. And then folks in the equity market are rotating aggressively into sectors that benefit from lower yields. And so you have utilities and staples, healthcare, real estate have been the largest beneficiaries of that. And when you think about it, Mag 7, I think market cap peak was maybe close to 17 trillion. And so a 10%, check back in the market cap of Mag 7, $1.7 trillion needs to go somewhere, right? It needs to find a home. And, you have these big companies like whether it's a Walmart or I know you had a chart of Berkshire up there earlier. There it is now, or Costco. These are the names that benefit the most. And so,
Craig, guess what? Craig, listen to this one. since July 5th, you won't see this in your life. Maybe like 2 to 3 times. Craig, since July 5th, Microsoft is underperforming Berkshire by I think it's 20%, Craig. 20%. That is a colossal migration of capital from growth into value, right? And that's one of the things that we talk about when markets speak, is that when there's evidence, Craig, and I want you to comment on this. The thesis is, if there's evidence of a sustained potential rebound in inflation, money is going to go from growth back to value. Whereas if deflation is certain, and think about the last like 6 months, inflation's been coming down. The Fed's been lecturing us. Inflation's under control. So the last like 6-9 months, a lot of money went from value back to growth. And what we've noticed, and what we're hearing, we run the Bloomberg chat. If you're on Bloomberg, please come in to us. Find me on Bloomberg, Larry McDonald, and we'll bring in the chat. But the institutions that I'm talking to globally, they think that we're now on a shift from growth back to value, because you got the China stimulus, which was unexpected, because you get the 50 bips of rate cuts from the Fed, because you have the port strike, which is going to be much more inflationary, right? And because we have this, Washington was at 1.4 trillion of deficit spending. That was the estimate from the CBO. Now they went to 2 trillion. So I think it was like 1.6 to 2 trillion. So you get the fiscal overdose, you have protectionism, you have the port strike, and then you get the China stimulus, and you get the Fed rate cut, right? So the probability that we have a bounce in inflation, that is the market, the beast in the market, how to listen when markets speak. The beast in the market is starting to move money from growth, which is really kind of the deflation back to value. Would you push back on that? What would your comment be on that?
I would say one of the biggest triggers that I've noticed is the price of gold. I mean, gold typically anticipates these turns in inflation. Gold has historical, strong correlation to real rates, or to negative real rates. And as real rates fall, the gold price, starts to move. And so I think the gold price has been anticipating this transition into a more inflationary environment. Call it 6 to 12 months from now. It's not for today. It's not, it's not going to happen tomorrow. But this is how the market is looking ahead and saying all these things: rising geopolitical concerns, deglobalization, potential for big tariff regime shift next year. The deficits, as you point out, and then some of the shorter term things about port strikes, about the Boeing strike, about hurricane issues in North Carolina, leading to a big potential huge infrastructure necessarily rebuild.
Hey, Craig, so, how are these economists? We'll finish it with this, Craig. I want to ask you, say you're an economist, right, at Goldman Sachs. You got the hurricanes, right? You get the port strikes. How, in the name of God's green earth, Craig, how are you going to possibly handicap the jobs numbers, the next 2 to 3 jobs with every, well, I guess the next 2.
It's right? Less, the jobs report that comes out on Friday for the month of September will not be impacted because the survey period was over. But for the month of October, which comes out November 1st, Boeing strike, hurricanes, East Coast port strike. I mean, we're very likely to see a potentially, negative number for overall jobs. And that's going to have a big, impact on how the Fed thinks about the labor market. Now, they'll push back and say, well, this is transitory. There's that vicious T word again about transitory, but it's hard to get a real sense for labor momentum when you have these exogenous, variables that could have some real implications. I mean, the port strike, every day that goes by is, 4 to 5 billion of GDP impact. We're in day 2 now. The port workers are looking for a 70% price increase, 70.
So they rejected 50, they want 70.
And that last I checked, that's above 2%, which is the inflation target. And they also, but the big thing for them is they want to slow down on automation, right? And I think this is a big theme that we're going to see over the course of the next few years, is unions trying to push back against automation trends and robotics. And this is going to be a big, point that we have to keep an eye on.
You know what? The point in our book, When Markets Speak, right? The point in our book is, there's a line, I sat down with Andre Estefes in Brazil in his office. He's the CEO of BTG Pactual. He said, Larry, we've been dealing with inflation for years. It gets under the seat cushions. It gets under the rugs. And I'm like, what do you mean? And he talked about unions, right? He said, Larry, when you have union power, right? If you're in a deflationary world, if you're a union boss and you're trying to organize a labor strike, or you're trying to organize, keep the union together, if there's deflation or, no inflation, and your, wages are going up, it's relative, so it's not that difficult. But once you go into an inflationary regime for 2-3 years, right? Imagine being a union boss. It's so easy to organize labor across many cities. That's why inflation gets that's what he was saying, gets under the seat cushions, because now the union bosses could say, but the employees are just so wounded because of 30% inflation, 25-30% over 3 years. They're trying to put their kids through school. They're trying to put food on the table. I know some of these guys get paid very well, but the bottom line is their real disposable income after tax and inflation has come way down. And this is a must read, How to Listen When Markets Speak. But Craig, I think that's it. We want to keep it short. It was a great work to give people a little lens on what are the professionals talking about this week. Thanks a lot, Craig. Any closing comments?
No, this is great stuff, Larry.
And the biggest thing is Craig's, we're going to make the announcement soon, but Craig's part of the Bear Traps team, done a phenomenal job this year. I think you're speaking tomorrow at a family office event in Florida, right? And so all of the Bear Traps families are going to be, know Craig a lot better over the next, between the next couple of weeks, next couple of months, next couple of years. So thanks a lot.